Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Note Closure Show. As always, Scott Carr, so excited to be here with you today. Today's episode, we're going to feature on something that I've been getting a lot of phone calls, a lot of questions about, especially from a lot of the posts that we've been doing on our socials, talking about the non-performing, apartment complexes or the non-performing. Like we just posted something about the Mandarin Oriental Residences in Beverly Hills and how that's going to default or defaulted in August and is going to the foreclosure auction. So just want to go through because I literally get so many calls from people like, hey, how do you find commercial banks that have this bad debt? And what's funny is I was thinking this morning, literally just before I started the phone call, I was like, I wonder how far I went when I was talking about how we're going to see this big meltdown. And I went back to, it was literally March of 2020, right at when the shutdown took place. We had a $50 billion, I said, meltdown in episode, how they were, sending us all home, couldn't go out there anywhere. I said, it's literally a freaking nuclear bomb went off in the commercial real estate market. It was just a matter of time till the fallout happened. Well, fast forward two and a half years, we have that happen. And we have that happening not just on the traditional commercial real estate side. We see that also on DSCR loans. We see it in a variety of banks that have this commercial real estate. And the thing about it is, not all banks are hurt, obviously. Look, let's just take a look. Let's be honest. This time around is different than 2008. In 2008, 9, and 10, it was a lot of the residential loans were causing a default. The ARMs, the rates increasing a little bit there. It was a residential meltdown. That's not the case this time. It is a commercial meltdown, and it will have far-reaching results. I had a couple coaching students in this weekend asking about some of the commercial notes, and if I was going to jump on some of these assets, I was like, well, yes and no. I think we still got a long way to go. I still think the bottom has not hit us yet. All right. And the reason I say that is we still have a tremendous amount of loans that are supposed to be refinanced or that are maturing in the next 12, 24, and 36 months. I mean, trillions of dollars in commercial real estate loans that either need to be modified, forbearance, or they're going to get foreclosed. And so you have this huge tsunami of commercial debt. But if you want to tap into today's world, how do you find that debt? How do you find the banks that have got the most amount of distressed debt on the books? Well, there's two factors on that. Okay, there's a couple ways to look at that stuff. And it's pretty simple to look at it because the aspect of who has what, all you've got to do is look at what banks, FDIC chartered banks, have filed their quarterly reports, and they have to report what they have as far as assets, who's underwater. And underwater means that they have a lot of debt as far as loans written out. And underwater, that paper is not worth the asset class that's securing it. All right. The property isn't worth, the paper isn't worth the property. Like if the loan's at 2 million and the property is only worth $1 million, that's an underwater asset. Okay. And we can get into what the borrowers have options for as far as refinancing or working with the banks. A lot of banks have been doing forbearances. They're hoping that they'll kick the can down the road 12 or 24 months and wait for the actual rates to get better. Well, hopefully they do get better because that's what's caused a lot of the stuff to go the way of the shit pile. Interest rates ran up, causing mortgage payments to increase, sometimes double, triple what they expected. The borrowers on these properties didn't have the money for the increased payments. They had to pick, do I keep the property floated or do I rehab the property, increase rents? Well, they had to basically keep the property going, hoping that the can would get kicked down the road, or they would be able to, things would change, and that hasn't changed. That's why you see all these properties going to foreclosure in a lot of cases. All right. And good morning, everybody. I see a lot of people join us on here. Good morning, Jay. Good morning, Mark. Good morning, No, Salazar. Great to see you all. Maceo, great there. Good morning, John. It's great to see a lot of folks that join me online here. The thing that you have to keep in mind more so than anything else is that while banks can kick the can down the road, they can't kick the can down the road forever. Either A, they're going to get taken over. The judges, Justice Department will step in, the banking departments will step in and sell them off, like what happened with Signature Bank and the Bank of New York and all those others out there. And you're already starting to see banks that go out of business or they get bought up by bigger banks. I mean, it's just kind of a repeat of the same old story that happened in 2008, 9, and 10. You know what I mean, ladies and gentlemen? So the thing to look at is who has the most underwater debt. I mean, who's got the worst negative ratios out there. Now, what happened when we talked about the banks that were going out of business, there was an article that came out, 94 banks are set to go out of business. I think it's not as bad as that initially, but I do think we're going to see a lot of banks that either get bought up, merge with others, and things like that. Now, the Florida Atlantic University has a professor out there that did a finance report on the banks. And what they did is looked at three things. They looked at the banks with the most amount of uninsured deposits. That means if they've got deposits of, depositor has $250,000 with them or $1 million with them, and they're only insured for $250,000. That's their uninsured deposits of $750,000. Okay, that's not that big a threat in a lot of cases because we're not going to really see a true run on banks anymore. But what they do have, they have unrealized losses on their investments where they put money into treasuries and other things that were low interest rate bearing, 1-2% because they had to do something with that money. When interest rates are at 6%, they're losing technically 5% every month, on those bad investments. But the third thing is the distress of commercial real estate. Who's got the most amount of distressed stuff or upside down stuff was the biggest factor we looked at. So if you're joining me live here on Zoom or watching on YouTube, and if you're not subscribed to my YouTube channel, you can do it by going to weclosenotes.tv. But if we go over here to my new share my screen here so you guys can see it. If you go to, here we go, the FAU College of Business, and it's U.S. Banks Exposure to Risk from Commercial Real Estate Screener. And you just Google FAU Bank Study, and it will give you that. So it says basically bank exposures to commercial real estate. And what they did is they literally pulled up and looked at all the banks that have commercial. Now they picked the top 125 banks out there. And if we look at this, let me just go to 100 per person. Now, obviously, it's got all sorts of stuff. You could look at the state that they're in, the total assets in millions, the total equity in millions, the equity to assets, commercial real estate total in millions, but then the commercial real estate total to equity, which is the big thing, meaning that they've got more real estate. If it's over 100%, they've got paper that's not worth what it's written. Okay, the asset isn't worth what the paper's written for. So upside down. And some of these banks go from the highest is 618%. And that's Eagle Bank in Maryland. Now they've got total, $7.2 billion in commercial real estate. But they're upside down 618%. All right, 618%, 618.6%. Dime Community Bank in New York is second at 618% negative. The Bank of the Ozarks, yeah, that's right, Jason. Eagle Bank in Maryland. Okay, Bank of the Ozarks out of Arkansas is just under 597 million, or 597%, I'm sorry. First Foundation Bank out of California. They are at 585.7%. Merchants Bank of Indiana, okay, 559%, 559.5%, so just under 560%. So Flagstar Bank, National Association of New York, they've got 554% upside down. Now they also are trying to sell off a big portfolio of residential notes. We just had a tape of notes coming from Flagstar Bank of 285 notes that they're looking to get rid of, sell off of on an individual basis. Okay, so they're trying to collect some reserves, some cash in to offset their reserves or offset that negative of where they're at on that, which is sad. Service First Bank out of Alabama is next, 550% upside down. Live Oak Banking Company out of North Carolina, 540%. Provident Bank out of New Jersey, 516%. Then below that is First Bank out of Colorado at 490%. Independence Bank, doing business as independent, out of Texas. That's the scary thing, 424%. I'm sorry, 474% on that one. First United Bank and Trust Company out of Oklahoma, 468% upside down. Farmers and Merchants Bank out of California. All right. to Google, just go to FAU Bank Investment Study, commercial real estate study. FAU Bank Study would be the easiest thing. And then just look at the article that pops up and click on the actual report. Or you can message me directly here or shoot me an email at scott@weclosenotes.com and I'll send the link to you. Or when we'll put the link into the video here on YouTube and our podcast as well for you guys to go and be able to do it. So, okay, so we're at Farmer Merchants Bank. Next one is Apple Bank out of New York, 464%. Valley National Bank out of New Jersey. Berkshire Bank out of Massachusetts. Columbia Bank out of New Jersey. City National Bank of Florida is still at 439%. Synovus Bank out of Georgia. All right. Synovus Bank, we bought debt from 435%, upside down. Bremer Bank, National Association out of Minnesota. Zion's Bank Corp, National out of Utah. Bank of Hope, California. Bank of California. Bell Bank out of North Dakota. Banner Bank out of Washington State. Sandy Springs Bank out of Maryland. Trustmark National Bank out of Mississippi. These are still at 400%, 4 times the debt, the commercial real estate loans, and what the property's worth. Okay. Is Israel Discount Bank of New York, Washington Trust Bank out of Washington State, Axis Bank of California, Popular Bank out of New York, Umpqua Bank out of Oregon. So that's below 400% now. So if you're just joining the live aspect of it, we're basically going through the report that Florida Atlantic University did on studying banks that had negative balances of commercial real estate, where basically the paper written in commercial estate is way more than what they have as far as equity or assets. So like if they have a $5 million loan, but the property is only worth 2.5 million based on current situations, that's a negative 200%. You get what I'm saying? So that's what we're doing, going through, just giving me a bit of a feel. Now, what do we do when we see this list? So here's a great question. Jason asked a question: how can you actually get the opportunity to buy the asset from the bank? Well, so here's the thing. You're buying the debt. You're not buying the actual property yet, because the debt on this is commercial real estate debt. So you're buying the loan. Now, some banks, some institutions, some REITs, some hedge funds are selling their debt off at bigger discounts. There was an article in The Real Deal talking about a big multifamily syndicator, an office syndicator lender who was selling their debt at 50, 60, 70 cents a dollar or less, depends on where it's at, okay? You're already seeing note sales coming back where stuff is selling at bigger discounts. The thing is, when you buy that note, you want to buy that note at a discount that makes sense, so that if you do take the property back, you have to foreclose to wipe out any liens and stuff like that behind it. All right. Is that you buy that debt, you don't own the property until you go through the foreclosure process. Now, in some cases, the borrowers know they're upside down and they'll do a friendly foreclosure, deed it over to you, do a consent to judgment so you can expedite the foreclosure to wipe out any outstanding mechanics liens, debt that's in the junior lien position. Because if you just take a deed in lieu, cash for keys, or it doesn't wipe out the lien. So you're still going to have to go through the foreclosure process. And that will vary on a state-by-state basis. If you're buying stuff in New York State, it's going to take you 2 years or more to foreclose if the current lender has not started. Now, if you're in Texas, Texas does things pretty fast. You can foreclose pretty quickly once the borrower is 90 days in default. All right. So that's the thing, is to acquire the asset, you got to look at the debt. If you're buying the note, you got to buy the note at a discount that makes sense for you. So if you do take the property back, what's the cash flow? What's the money coming on that asset? Does it make sense to take it? There's been some assets that we featured where the asset sold at like at $11 million or at 25 cents on the dollar, what it originally sold for back in the day. But it's a vacant asset. Like there's some of the stuff that's selling in like San Francisco in the market area. I don't know what the hell those lenders are going to do, or the new owners are going to do with those properties. It just doesn't make sense, because it's just a explosion in downtown San Francisco. Nobody wants to buy down there. Nobody wants to visit down there. Heck, when pro football players are getting shot for going to shops that are still open down there, trying to get robbed at gunpoint, it doesn't breed well for a lot of things. So let's see your question here. So Jason, here's the thing you want to look for. There are different departments at the banks. I'm glad you asked that, because that's the next route that we're going. So you don't contact the customer service number. They're not going to know who the heck you're talking about, right? You got to call the main corporate branch of that bank and ask to speak to somebody in charge of special assets or secondary marketing, or their distressed commercial real estate department. Okay. Usually it's a special asset manager or secondary market. The reason a secondary marketing manager is that's the person that's taking a look at the bank's loans and trying to sell that stuff on the secondary market. They're not selling to other banks, but they're looking to sell it to other investors like you and me. Okay. Now, the great thing about a lot of these banks, these are going to be technically, Wall Street's not going to be targeting. Now, Wall Street might target assets that are over $5 million. That's the kind of their bread and butter. That's like the bear hurdle where they might look at a deal. It's 5 million, but mostly it's going to be 5 million or greater. So some of these that are 20 million, 50 million, you're not going to buy that individually, but you can oftentimes buy that stuff that's below that. That's why these smaller banks, like some of the stuff here, when the commercial real estate stuff was basically financed this time around by 60 to 70% of it was financed by banks, just like, and that's why they're in trouble. They overfinance, they don't have the resources, they don't have the deposits, and they've got to do something. And they either need to sell and take a loss, but get some cash in to help offset reserves that are negative right now. Okay, so we've been looking at this FAU report, Florida Atlantic University, on the distressed commercial real estate. U.S. banks exposure, if you just go Google U.S. banks exposure to risk from commercial real estate screener, FAU, it'll pop up with a report for you. Now, who do you contact at the bank? Well, I like to leverage LinkedIn. So if we go over to LinkedIn, all right, we look at LinkedIn, and then if you go up and look for people, I'm going to move my phone over here for those that are joining me live here. Thanks for asking questions. Thanks for commenting. And let's go over and just type in Eagle Bank. And we're going to look for Eagle Bank in Maryland as a company on there. Okay, and we're looking for companies. It's Massachusetts, Chicago. Here we go. Eagle Bank, banking, Bethesda, Maryland. It's got 10,000 followers. I'm going to click on that. I'm not going to follow it, but I'm going to click on it. And I'm going to click on people in the next tab over here. Now, I'm going to look for special assets, secondary marketing, chief credit risk officers. These are some of the job titles I'm going to look for. And I'm going to scroll through. I'm not going to look for, commercial real estate deposit assistant. That's not going to work. Loan operations manager. I might be able to reach out to her. I'm just going to keep scrolling down here until I hopefully find somebody that says special assets manager, secondary marketing manager. That's the first thing I'm looking for on some of these major banks. Now, if I go down here, scroll down, keep scrolling down, I'm looking through the job titles. Here we go. Commercial real estate portfolio manager at Eagle Bank. I'm not going to name her name. It's a third-degree connection, but that's who I would reach out to. Now, she doesn't have a picture in her profile, doesn't have a background image, but I at least have a name to reach out to. And she's at Vienna, Virginia. She's only got 59 connections. Okay. But when I call the office or call the main commercial office, that's who I'm going to ask to speak to. Okay, you're a portfolio manager. Hey, do you have any of these loans you're looking to get off low, sell off your books? Let's see if we can't find a portfolio manager. Just because, or a secondary marketing manager. Okay, vice president, Eagle Bank, no. I was a vice president at Chase. Didn't mean I had any type of power. Okay. Let's see. Senior vice president, no biggie. Office manager, no. I mean, there's a vice president portfolio manager, no. Let's see here. What else? I looked this weekend. I was able to find a name, and I meant to write it down. I completely forgot to do it, but that's okay. So we've already seen portfolio manager for commercial real estate. There's a commercial real estate professional. That's not what we're looking. Another portfolio manager, commercial real estate. That might be somebody to reach out to as well. Let's see. Keep going down here. Keep going down here. They've got a lot of people on LinkedIn, which is good because it helps you find. Here we go. Portfolio manager, special assets. That it would be an ideal person to contact. Commercial real estate portfolio manager, special assets. So what am I going to say to him or her? Well, I'm going to send him a connection request. Okay. And I'm going to send a message to him. Say, hey, blank, I think you're the person in charge of special assets there at Eagle Bank. I wanted to see if you had any notes or loans on your books that you're looking to get rid of this quarter. And that's the whole goal. Now, if I click on contact information, maybe sometimes you'll get lucky and there'll be an email address. No, there's just a profile. But guess what? I have two names now that I can reach out to. If I call the corporate office and ask to speak to person A or person B here now. Okay. Now, if you're watching this live on Zoom, you're actually seeing me share the LinkedIn. If you're just watching on TikTok or something else, you're probably not seeing that. But literally, there's a couple people. Now let's go back here and look for another person, just for the heck of it, because these commercial companies often will have several people available. Oops, I clicked too far. Anyway, but you get what I'm saying. Hopefully this makes sense in the outreach. Now, what do you say? Hey, I'm buying for my own portfolio. What you do not say is, I'm looking for notes and REOs. That's not worth their time. They don't need an REO agent. They need somebody who's buying for their own portfolio. Now, they don't expect you to buy their whole portfolio. Usually they'll send out a list of notes that they have. It's a spreadsheet, Excel spreadsheet of stuff that they're looking to get rid of. You might have to sign a non-disclosure agreement. You don't want to go blast this all over the universe. But if you get a tape of notes, then it's all about, hey, when was the last payment made? Looking and doing your deep dive on the due diligence aspect of it and seeing what's going on. Now, this is an opportunity for you to pick up some commercial debt at probably a big discount, and then take the property back by either foreclosing or working the borrower, as long as there's not any mechanics liens or liens on the property. Now, some of these multifamilies we've seen where there's been huge mechanics liens because they have not paid their staff, they've not paid their vendors, they've not paid the people that have gone and done the rehab work. Somebody asked me that this weekend. Hey, I've got a mechanics lien on a property. How do I collect on it? Well, you can either go after the fixers, sue the LLC, or see if the LLC owns other property or real estate and go after that. But otherwise, you're pretty much SLL, and you may just have to 1099 that borrower, that LLC, for your loss, as they pay taxes on it, and you can write it off your taxes, unfortunately. But if you're joining us there, once again, we've used the Florida Atlantic banking report on banks with the negative commercial real estate. It gives us a list of banks that have the most amount of upside down debt as far as ratios of the commercial real estate to their actually equity, and the banks and how to contact them. Now, somebody asked me too, like, okay, this looks great. What about the bigger banks? What about Bank of America, Chase? What does it look like for them on that class? And I thought that was probably a good idea to pull up, because you can go on here and this report is clickable to change it up. So let's just click on the total assets. We click on the banks with total assets and resort it. So you have JP Morgan Chase Bank, $3.5 trillion in assets, and they're only sitting at a 55.9% commercial real estate total to equity. So they've actually sitting at a pretty good, they're below 100%. So they're actually sitting right. Bank of America, 2.5 trillion, they're at 35.2%. Wells Fargo has 1.7, they're at 90.8%. Okay. So they're a little higher. You might reach out to Wells Fargo multifamily, Wells Fargo commercial. They've got a couple of different departments that handle that stuff. U.S. Bank of Ohio has 664 billion. They're at 85%. PNC Bank out of Delaware, 97.5. Goldman Sachs in New York only is 22.5. Truist Bank is at 93%. Capital One, who I've bought from in the past, is at 58%. TD Bank NA, 73%. Bank of New York Mellon is at 21.4%. And then State Street, Massachusetts, is at 10%. Charles Schwab Bank, SSB out of Texas, 0%. They really don't have any upside down commercial real estate. So that's why I said don't target those bigger banks. They're not going to sell you a one-off basis anyway. But if you flip it around and do the resort to commercial real estate total to equity as the highest percentage, then that's where the Eagle Bank, the Dime Community Bank, the Bank of the Ozarks, and yada yada go on from there. And that's what do? You go over to LinkedIn, you find a contact name for special assets, commercial real estate portfolio manager, secondary marketing, and you pick up the phone and call them and say, hey, what do you have on your books that you're looking to get rid of? Now, I'd be willing to bet they're starting to get some phone calls. But the first sign is like Flagstar is number 6 on here at 554% of commercial real estate. They've also got residential notes that we've taken a look at. We didn't bid on anything. They will still want too much for their distressed residential stuff, but I'd be willing to bet in 30, 60, 90 days, they're going to come down. And that's why it's so important. If you take the time to start making connections now, maybe you don't get anything this month. Maybe you don't get anything this quarter. As we get into the fourth quarter, Q1 of 2025 and mid-year, when literally more bloodbath, more loans are maturing, more loans need to be refinanced at that point, it leads to a lot of opportunity. And the more distressed an asset is that they haven't sold off, the bigger the discount they're taking. And that's why commercial notes are great, but you're not going to It's not an instantaneous thing. It's literally more of like a 90 to 6 months, sometimes a year process in buying notes from a bank. We bought a lot of notes from banks. That's actually what I started doing 20 years ago, was contacting banks and getting lists from like Union Bank, Oceans Bank, U.S. Century Bank out of Miami, Capital One, Wells Fargo, multifamily, City National Bank out of California. There's a whole lot of banks that we've bought commercial debt from over the years, but it's just a different thing. And you got to be, every asset's unique. And so you got to understand the location, what's going on with it, and going from there too. All right. What other questions do you guys have? Anybody got any insight they'd like to share? As always, you can send me an email at scott@weclosenotes.com. That's my direct email. If you'd like to schedule a phone call with me, just drop me an email or go to talkwithscottcarson.com. That's talkwithscottcarson.com and book a phone call on my calendar. I'm here to help you guys. There's so much opportunity and deal flow to go around. Make sure you hit the follow and subscribe button. And I look forward to working with you guys here. So many deals, so many opportunities. Let's go out and create some win-win-win scenarios. A win for us, a win for our investors, and also a win for the banks getting the stuff off their books. And even a win for the borrowers who are probably in a troubled position. They didn't plan on it. You know, maybe they didn't finance properly, but doesn't mean they were bad people to begin with the way the market was. So anyway, go out, take some action, buddy. Thank you for subscribing. Thank you for liking. Thank you for sharing. And we'll see you at the top, everybody. Bye.